Welcome back to another explainer. Today, we are going to unpack a massive secret that is quite literally hiding in plain sight. Look, if you've ever felt the absolute, soul-crushing frustration of getting faked out on a trade, well, you are definitely not alone. The reality is, retail traders are constantly losing money because they're staring at incomplete data. Seriously? Standard 1-minute chart candles? They're lying to you. They completely hide the real David versus Goliath battles happening right under the surface. So, grab a coffee because we're about to show you exactly why those sudden, brutal reversals happen the second you enter a trade.
Okay, let's kick things off by asking a pretty critical question. When you see a standard candle print on your screen, do you actually know what the institutional whales are doing inside that price action? Like, really doing? Because the truth is, without the right tools, you are flying completely blind. A massive green candle looks like extreme market strength to the naked eye, right? It practically begs you to FOMO buy in. But underneath that illusion, that so-called breakout could secretly be a massive trap just waiting to spring.
To understand these hidden battles, we really have to look at the physics of a concept called absorption. Imagine a speeding car just slamming into a reinforced brick wall. Boom. That is absorption. It happens when massive institutional limit orders completely swallow up all the aggressive market orders coming from momentum breakout traders. So, retail keeps throwing buy order after buy order at the market. But the whales? They just absorb every single one of them until the buyers are completely exhausted, and all that upward momentum just abruptly halts.
All right, we're treating this explainer like a fast-paced, tactical briefing today. We'll start by unlocking chart X-ray vision, decode the trap bubbles, and establish the bubble size rule. Then, we'll dive straight into the actual execution with the institutional fading strategy, and finally, the trap failure scalp. Let's get into it.
First up, unlocking chart X-ray vision and actually seeing the battle.
What's really fascinating here is how this tool acts like an X-ray machine for your charts. Now, you might be thinking, don't traditional footprint charts already do this? Well, yeah, but let's be honest. They are notoriously noisy, incredibly complex, and usually cost an arm and a leg. They create way too much friction for a fast-paced scalper. This approach, though, is beautifully elegant. It plots simple, distinct green and red bubbles right at the specific wicks where major CME volume was definitively transacted and absorbed. It literally highlights the exact battleground for you in real time.
So how does it actually pull this off? It uses a brilliant mathematical concept called wick decomposition. Think of it like a polygraph test for the market. It doesn't guess. It mathematically tracks the CME volume via a proportional volume split inside the wick, checks it against a minimum volume threshold, and then compares it to the opposite wick. Basically, this math cuts right through the noise and definitively proves exactly when one side of the institutional auction got completely and utterly crushed.
Now that we know how to spot the battles, let's move on to decoding the trap bubbles. Red versus green.
This is where we run into a completely counterintuitive dichotomy that you absolutely need to master. In standard, everyday trading, our brains are hardwired, right? Green means go or buy. Red means stop or sell. Well, scratch that. Here, you have to flip your entire mental model. Green bubbles actually represent trapped buyers who are looking to go long, which makes it a powerful short setup catalyst. And red bubbles? Those are trapped sellers trying to short the market, which incredibly becomes a major long setup catalyst. Let's really break down the pain of these green bubbles for a second. Picture this psychological panic of the retail momentum buyer. They aggressively bought market orders at the absolute very top of the candle, totally expecting the market to shoot to the moon. But instead, they slammed right into that institutional whale wall and were instantly absorbed. When the candle closes below their entry, they are suddenly trapped deep underwater. The absolute panic and the forced market sell orders they need to exit those losing positions becomes the exact momentum that violently drives the price down. It's brutal.
And you know, it's the exact same dynamic, just flipped, for the red bubbles. You've got aggressive short sellers slamming the absolute lows, desperately trying to break a key support level. But nope, they get completely absorbed by hidden limit buyers. As the price holds and that candle closes above them, those trapped sellers start sweating, fast. To protect their accounts from blowing up, they are forced to trigger their stop losses. And all those buy-to-cover orders, they act as pure unadulterated rocket fuel, igniting a massive, rapid upward surge in price.
Okay, moving right along to the bubble size rule. How do we actually measure the trap?
This is crucial. Think of these bubbles like a tightly compressed spring. The larger the bubble prints, the higher the volume of aggressive contracts that were just eaten up by the limit wall. That means there is a massive, and I mean massive, amount of trapped liquidity sitting right there. And just like a heavily compressed spring, when those trapped traders finally crack and capitulate, the resulting snapback is going to be incredibly violent and explosive.
Let's transition into the institutional fading strategy and look at some high-probability reversals.
Before we talk entries, hear this loud and clear. Location is everything, literally everything. Taking a trap signal in the middle of nowhere with absolutely no surrounding market structure is a fantastic way to drain your trading account. To gain a true edge, you have to exercise discipline. You must filter these signals using established structural confluence, things like descending EMAs and major demand zones. This ensures you are fighting alongside the institutions, not trying to stand in front of them.
All right, let's walk through the play-by-play for a short entry. Picture this. Price is rallying hard, moving fast right up into a red supply zone or a descending EMA. Retail is getting super hyped, then boom, a large green bubble prints right at the top wick. This is your visual, mathematical confirmation that the buyers have exhausted themselves directly into institutional supply. You don't guess, you wait for that exact confirmation. Then, you confidently enter short on the very next candle's open, catching the reversal as all those buyers start to panic.
To go long, you apply that exact same patience. You watch the price drop aggressively into a cyan demand zone, or maybe it perfectly tests that red 200 EMA line. Now, the amateur tries to catch the falling knife here, but the pro waits. The exact moment a large red bubble prints at the bottom wick, it proves the sellers have totally exhausted themselves into institutional demand. Once you have that definitive exhaustion print, you execute. Enter your long position immediately and ride that wave back up.
Which brings us to the trap failure scalp. What happens with trend continuation?
Okay, this is where things get really fun. This is a thrilling plot twist in our trading playbook, the trap failure. The market is a wild, dynamic beast, and sometimes the institutional absorption wall actually gets broken. When Goliath fails and the market just blows right past the signal, it creates a massive trap of a trap. And let me tell you, the resulting momentum from this double failure is next level.
Here is the pure, beautiful chaos of the short squeeze breakout. Imagine a green bubble prints. The early sellers rub their hands together, thinking they have the buyers trapped, so they aggressively enter short. But then, the very next candle violently pushes straight through and breaks above the high of that bubble. The buyers actually overpowered the wall. Now, the sellers who tried to defend that absorption wall, they're the ones trapped underwater. This double-layered panic triggers a massive short squeeze, giving you the absolute perfect opportunity to scalp a quick, explosive momentum long straight to the next local high.
So as we wrap this up, armed with this incredible X-ray vision into order flow and wick decomposition, the way you look at charts should be forever changed. You no longer have to guess what's happening inside the candles. It's all right there. So the very next time you see a massive breakout candle pushing to new highs, I want you to pause, look a little closer, and ask yourself, is this true momentum, or who is really trapping who?